I'd just like to welcome everyone to the session on managing portfolio risk, solving the unlisted asset challenge. My name's Mark Williams. I'm the Manager of Investments for Tasplan Super. The desire of superannuation funds to diversify away from traditional markets into alternative assets brings new challenges. These challenges include understanding how unlisted assets affect not only the overall risk dynamics of the portfolio, but how these dynamics affect member outcomes. Factor analysis has become an increasingly popular tool, and this session will compare traditional factor models as well as latent factor approaches. So would you please welcome Dr. Jeffrey Bond to the podium.
All right, thank you. This is a tall order after lunch and an analytics-related discussion. So I'm going to try to keep this somewhere in between, technical, but still give you enough of a view that you can grasp the concepts. What I'd like to do is start out by giving you a couple of examples from the non-financial area. And you might think that's a little strange to start out that way, but one of the things that we're doing at GX Labs, that's the group that I'm running in San Francisco, is trying to leverage capabilities that are in other sectors besides finance and bring those to bear on some of the financial problems, specifically the risk problems. That's what I'm specifically working on. And I think it's actually easier to grasp some of these concepts in other areas. So I'm going to start there. Then I have a couple of questions just to try to get an idea of the level of interest in investing in alternative assets. And then I'm going to try to walk through a presentation on how we think about a multi-asset class integrated risk platform, specifically one that can accommodate unlisted and alternative assets. So that's the general overview of this talk. So I want to start out by talking about the medical area, because that's something that you may or may not be aware, but there have been a lot of incredible breakthroughs as a consequence of specifically data science in the past few years. And this is specifically in the area of cancer research. And what the medical researchers are finding in this area is that by combining our understanding of the human genome, which is something like 4 billion base pairs, so that's like a huge data science problem, and environmental issues, and then other molecular issues around the human body, they're discovering that there are ways to design drugs that are specific to individuals. And right now it's too expensive and it's still quite new, but this is probably a path for cancer research. And what's interesting about that is it's a combination of data science work, which really hasn't been, and often people use this term big data. I'm going to try to define this a little more concretely as we go along. But this big data that really has only been in the last 4 or 5 years in terms of what we can handle technologically, this is now enabling us to do this type of work, and it's quite exciting. That combined with an understanding of conditioning variables. Now, the technical term for this is Bayesian analysis, but I won't use that. But it's this concept of conditioning on things is also quite powerful. So if I take the data science and I combine that with conditioning capabilities and apply it to some of these problems, say like cancer, all of a sudden I have a new paradigm for solving what's long been a very difficult problem. And I'm going to talk in this presentation about how that can work in the portfolio risk space. Now, as an aside, there are actually some people, this is a presentation on unlisted assets. There are some people that I know quite well that are working on new investment products that are called research-based obligations. And what's interesting about these RBOs, and it's not clear to me yet whether these will take off or not, what's interesting about these RBOs is it takes this portfolio theory to specific research topics, say like cancer, where it affects a large number of people. For example, you may or may not be aware, but 30 to 40% of every human being will be diagnosed with cancer over their lifetime. That is a huge problem. And the view is there's not enough investment there, but the problem is the big pharmaceutical companies, cost something like $3-4 billion to research a particular drug. They don't want to make those investments, and some of these portfolio products, where say I fund a whole bunch of research, but I do that as a portfolio, may potentially be an opportunity for actually cracking some of these big problems. So research-based obligations may be something that you'll hear about more going forward, maybe not, but that does, again, that's a consequence of these new capabilities that are being developed. So that's one example that I wanted to start with. The second thing that I wanted to talk about is actually a joke that I heard, and this highlights a very important point, the third point that I'm going to point out. And so two people were flying on an airplane, and one of them happened to be an engineer, but very focused on linear analysis. And while they're flying, the pilot comes on and says, I'm really sorry, but one of our engines has gone out, and so it's going to take us an extra hour to get to our destination, but you shouldn't worry about it. And so the two said to each other, that seems to be okay. So then a few minutes go by, and the pilot comes off again and says, I really apologize, but a second engine has gone out. But don't worry, these planes are designed to fly on less than 4 engines. It's going to take us 2 more hours to arrive at our destination. And then maybe half an hour goes by, and he comes on again, and he says, really sorry, but the third engine's gone out. It's going to take us 3 more hours to reach our destination. And then the engineer that only done linear analysis leans over to his colleague, and he says, I'll bet if the 4th engine goes out, it's going to be a 4-hour delay. Now, what this joke highlights, which is another point that I want to highlight as I go through this, is nonlinearities are a huge problem in portfolio risk. And you can be lulled into thinking that there's no problem. And many of our models that have been developed in economics and in finance rely on linear modeling and normal distributions. The problem with that is it doesn't always take into account the nonlinear nature of many asset classes, and we've seen the problems with that in the great financial crisis and even volatility we've seen recently. This becomes more pronounced in unlisted assets because now I'm typically dealing with leverage and liquidity issues, and that's another point that I want to highlight as we go along. So with that as an introduction, so I'm going to talk again just to keep this at a higher level. I'm going to talk about some of these data science issues. I'm going to talk about how we look at multi-asset class portfolio risk modeling, and then I'm going to discuss a little bit about how we can look at nonlinear modeling, or really the consequence of some of these new tools gives us nonlinear models of portfolio risk that I think do a better job of capturing the types of risk that most funds would be facing, if not all, in certain market environments. So before I launch into the presentation, I did have 2 questions, so if we could go to those. So if those of you that have the app, I was just curious to find out, how many people, I've given a variant of this presentation at a couple of different conferences around the world, and it's just interesting to note the differences. So do you plan to increase your exposure to alternative assets in the next year? So if you have access to the app. Wow, so that's pretty overwhelming. Okay, so that's good. So this is a very good topic then for everybody. I'll give you a couple more. Couple more seconds. Okay, can you go on to the next question? So how do you currently integrate your portfolio risk modeling or management? Is it the case that each asset class is modeled on its own? Do you model equity, fixed income, and credit together and then model alternatives separately? Or do you put everything on one platform? So this would be about your portfolio risk platform. Okay, so that's better than I've seen in other places. Okay, so I can safely say that you're definitely in lockstep with other regions. I've done this, an increase in alternative assets, and then this migration to integrated multi-asset class portfolio risk platforms. So with that as background, I now want to talk a little more specifically about how one can enable the ability to include unlisted assets, actually a whole range of assets, but the focus in this discussion will be predominantly on these types of assets. Now, as an overview, in terms of the presentation, I'm going to introduce some data science concepts. One is latent factor modeling. Secondly, I'm going to talk a bit about big simulations. So this is simulating forward-looking portfolio risk. And then I want to discuss a little bit about conditional analyses, particularly conditioning on the macroeconomic regime, and talking a little bit about conditioning on regulatory environments. And then third, one of the things that's a critical link in any multi-asset class portfolio risk model is a way to conditionally value your portfolio positions based on some kind of set of simulated factors. So I'm going to talk a bit about conditional valuation models, just highlight the fact that particularly for unlisted or alternative assets, the leverage, liquidity, and low probability large losses tend to be really more acute. Certainly credit instruments can also exhibit this type of behavior, even if they're traded corporate bonds. But this is particularly acute when you're looking at some of these types of exposures. And I think one of the themes that is threaded throughout this presentation is this notion that there are underlying common factors that may be driving the overall risk, despite the fact that you may have multiple asset classes in your portfolio. And the power in some of these new tools is the ability to disentangle those underlying drivers. And then I'm going to discuss as we go along just how this all knits together in a multi-asset class portfolio risk platform. I wanted to start with the wisdom of a Greek poet, Archilochus, who said that the fox knows many things, but the hedgehog knows one big thing. And this is a big problem I see in many financial institutions, and that is people get focused on a model or one approach, and they don't allow themselves to adapt. And what ends up happening is you may think you're getting consistent risk analysis, but you're trading off that for model risk. So one of the things that I think is quite important is, even though I'm going to talk about an approach here, I'm a big fan of multiple approaches for looking at some of these problems. And even within an approach, we're really big on scenario analyses, because that allows us to look at many things, allows us to be more of the fox than the hedgehog. The other thing is the wisdom of Leonardo da Vinci, that the acquisition of knowledge is always of use to the intellect because it may drive out useless things and retain the good, but nothing can be loved or hated unless it is first known. And the big problem I see in portfolios or portfolio risk analysis is a lack of appreciation of the concentration risks. What is really driving those? And if you don't know it, you don't know whether you should hate it or love it. One of the things I've done risk my whole career, and a lot of people think that risk managers or people that do risk are kind of pessimistic people, and it's always about what you can't do and what you're going to avoid. And while that's a big piece of the job, a good risk manager is also somebody that can say, no, these are the opportunities you're missing. If you tell me what your risk appetite is, and I look across the investment opportunity set, which would include, say, unlisted assets, my risk modelers, my risk managers may in fact be helping you find opportunities, but you can't figure out whether you're going to love it or hate it until you know it. And so that's something that's important with these models. And the truth is you can't intuit concentration risk without a model. You can have hunches about it, but that's one thing that these models allow us to do more effectively. And often when we're doing, say, big data analysis, really what we're doing is we're just replicating a very experienced risk manager, somebody who's seen a lot of data. In fact, one of the things that I've done over the years in my career is had a chance to actually spend a fair amount of time with really good risk managers. And you can discover things about their processes, about the way that they analyze data that can be used in some of these modeling. Now with big data, I now have access to many of these data sets, and that can be quite powerful. Now, before I get into the modeling, though, I do want to highlight a piece that's often overlooked, at least at the places I talk to. Different funds, different asset owners, or even insurance companies, banks. Although the regulators in banking and insurance are pushing those institutions more towards this kind of risk governance, is the fact that before you put any model in place, you need to make sure that you quantify what it is that the risk appetite is for the portfolio. Because otherwise, it's actually very difficult to figure out, once you've done the analysis, whether you want to be adding particular assets or hedging others or selling others. So, some interesting questions you might ask yourselves at your institution is, who sets the risk appetite? Is it an independent board? I've seen situations where risk appetite is set by the same people who make the portfolio allocation decisions. And so you end up getting corruption of that process. It's not fully independent. And then what is the risk appetite statement? Is it quantified? So, often there's an objective or target return, but do you have a specific tolerance for portfolio volatility? Do you have a specific tolerance for drawdown? The probability of losing a particular amount, because that becomes an anchor that you can start from once you've done the portfolio risk analysis to figure out whether these new asset classes or even the existing portfolio makes sense in the larger context of what you're doing. And ultimately, this is all dependent on how good your data management is. And that's one of the things that attracted me to State Street is just this focus on data. And I think that's something that's a big theme that has come to the fore in recent years is how important data management is, even before you get to the models. So if you've got the governance structure in place, what your risk appetite is, you've got the data process, then we can get to the modeling. I think that's the important point to take away. Because often I will work with institutions, or I will see people in training just dive right into the modeling without really talking about where you start. So this is actually quite an important preparatory step. Now, I think some questions that you should really ask yourself about your portfolio, and this is a way to evaluate how good your portfolio system is. First of all, what is your investment horizon for risk management purposes? This is quite important because many risk models that are used have actually been calibrated on small data sets over short time horizons. So I'll see models, for example, that they will look at forecast volatility over a day, a week, or a month, or maybe sometimes 90 days, and every once in a while a year. But for most asset owners that I talk to, their time horizons go much beyond that. So you need to match your modeling capabilities to the investment horizon. That's important. I discussed the fact that you need to understand what your institution's risk appetite is. At a given probability, and a probability that I like is 3%, but you can pick the one that you like, because that's 3% is 1 in 33 years. It's about how often we've had structural recessions. So in the event of a 3% problem, structural recession, how much are you comfortable seeing, or what level of losses are you comfortable seeing in your portfolio? And that really should be in addition to what's acceptable portfolio volatility, because otherwise it's hard to know which assets to add. One particular measure that we like is expected tail loss. Sometimes it's called expected shortfall. But this tells you if your portfolio ends up in that target region that you're worried about, say the worst 3% events or the worst 5% or 10%, what is the average loss in that tail region? This is actually a very powerful risk measure and can be used not just at the portfolio level, but it can also be used to look at the individual positions or sub-portfolios or asset classes and understand how those are contributing back to the overall portfolio risk. So for example, I can look at my whole portfolio, and let's say that my expected tail loss is something on the order of 10% or 15% loss. I can figure out which clumps of assets are actually causing that. And that's a very powerful aspect of that particular risk measure. And then that allows me to answer question 4. So that really then becomes my actionable decision information. So once I figure out which subportfolio or asset class, and I can cut this up over all different kinds of dimensions, that then should drive my allocation discussions, should drive my hedging discussions, and whether I really should be adding or subtracting from my portfolio. Now, what we've seen recently in the financial modeling world is a shift from the current mainstream, and I would say this is actually becoming less of a mainstream paradigm, but you still find this in many models, of assuming a normal distribution and then relying predominantly on linear models. Today, the new approaches that we're working on, and this is still very much research in progress, so you shouldn't leave here thinking that we have this completely resolved, but we are pretty far down the path of looking at things like, and this is now where I'm going to be a little more specific. People use the term big data a lot. But what you discover when you ask people about that term, what do you mean by big data? You get one of 3 answers typically. One answer is, well, we just get lots of data, and those people I'm not sure know what big data is. The second response is, oh, we're looking at pattern recognition. And so if I'm a social media company and I'm trying to target advertising to particular subgroups, I'm trying to recognize patterns. So that's a big piece of big data. I'm going to call that fast data, because that's about the way to make that useful is the ability to process a big chunk of data very quickly, okay? Because we've always been able to do this type of work. It's just that what used to take weeks or even months of computation time now can be done instantaneously. And that's the difference. And I'm going to call that fast data. But the other piece that's big for risk modeling, and interestingly enough, when you look at other industries, it's not quite as big of an application of big data as what I'm going to call big computation. Now, big computation is your ability to run, say, lots of simulations around future scenarios. So, for example, when we do our portfolio risk analysis, we tend to run something on the order of 500,000 to 1 million iterations in terms of the simulation. Now, that's a big step up from what most financial modeling quants are used to. So in some of my past jobs, I've done market risk analysis. And to run 10,000 10,000 iterations for a market risk model, say in the late 90s, that was considered a big simulation. Today, if I want to look at the tail risk of a highly non-normal distribution, and that's definitely going to be the case if I'm putting unlisted assets into my portfolio. One problem is many of our risk models are biased by this heavy focus on equity, and equity has more of a symmetric return distribution. So I've got roughly the same density in terms of downside risk as I do for upside risk. But when I move to other types of asset classes like credit or private equity or real estate or infrastructure, I'm going to start seeing situations where I have high probability of getting some return, maybe not as big as I might get for equity, but a low probability, but a non-trivial level of losing a lot of money. So that's this non-normal distribution. And to really capture that, I need to run many simulations. I need to understand lots of scenarios. What is it that, and historical scenario analysis is actually not that useful, to be honest. I mean, it looks good in marketing packages, it looks good in communication to boards, but for real risk assessment, you really want to figure out what the next crisis is, not what the last crisis was. And so that requires me to do lots of simulations, and that means I've got to do big computation. Now, I've spent one of the things, or one of the benefits of my job is I get to interact quite a bit with academics. So we have a relationship where we've created a consortium with UC Berkeley and Stanford. My team, GX Labs in San Francisco, has created this consortium. And so we get a chance to talk to a lot of different industries. And one of the more interesting conversations I've had recently has been with the people who model nuclear reactor risk, because they do the same type of simulation work that we do in finance, which is different than, say, when I talk to social media, their tools don't seem to completely come across in terms of application. But it's actually one of the things I've found as I've started getting more into this area of data science. I've been to more interdisciplinary conferences. There's a lot of things, a lot of risks out there, like I didn't realize in the United States, for example. There's a big nuclear reactor in Ohio, and there's a lot of worry that that may melt down because it was built like 30, 40 years ago. So trying to assess that risk has real tangible impact on society, and it's the same types of tools. It requires this big computation. Now there's some other new tools, and I'll just mention these briefly because we've just started working with them in the machine learning space. One is something called deep learning, and deep learning is quite interesting because it's the algorithms that are used to do, say, driverless cars, and also to do pattern or photo recognition. So they now have deep learning algorithms that can train on a photo, and then they put these up on the internet, and you may or may not be aware of this, but you're on camera like 60–70% of the time. And so now, with these tools, you can be tracked by your face. And that type of pattern recognition is quite powerful. We're hopeful that we can actually use that to infer what macroeconomic regime we're in. So this is an application that we're looking at. So I mentioned how important it is to do conditioning, this Bayesian type analysis. One of the things I want to know is I want to know what macroeconomic regime I'm in today. And if I rely only on government published statistics, I have this problem that everything is lagged and noisy. And we at State Street have had the benefit of looking at some research efforts. We have something called Price Stats that looks at real-time inflation indicators. The next generation of this analysis will look at a broader range of macroeconomic indicators and potentially use something like deep learning that's used for driverless cars or for photo recognition to try to figure out what macroeconomic regime that we're in. So that's quite exciting. All of this gives us more of an empirically focused, data-based, and non-normal or non-linear type picture of portfolio risk. And I think this is very important for unlisted assets because your ability to model these assets, I think, is directly, or the effectiveness is directly proportional to how much data you have. Now that's one thing that's an issue for brand new things. I mentioned these research-based obligations. There's really going to be no data, so you may have to look at proxies. But other types of instruments, say whether it be private equity or even middle market loans, there's now sufficient data that in the right modeling framework, I think you could infer the risk factors to understand the picture. Now just a quick discussion on some of the metrics that come out of this. I already mentioned the importance of expected tail loss. That's something that I think becomes much more important when you're looking at unlisted assets than volatility. Often I will talk to people about stress testing, and I make a distinction between scenarios and simulation, but it's really a false dichotomy, because if I'm running 1 million simulations, I'm actually just running a whole bunch of scenarios. One of the things that some of these new tools are allowing us to do is something called cluster analysis, where we can look at, say, paths of simulations that are problematic for our portfolio, and then potentially map those into macroeconomic scenarios we're worried about. So that's one application where I can do both simulation and stress testing or scenario-based analysis. But they're really cut from the same cloth. Now, one of the things that I did want to mention a bit in this context is that when you're doing the stress testing or scenario analysis, you really want to try to come up with scenarios that are plausible, but infrequent, but not so rare that your decisions don't change. And I found this quote recently where this academic said, "The worst data are better than the best theory. If you look for reasonable results, you will never make a discovery, or at least you will never make an unexpected discovery." And I think that's really what data science has given us, is now we have the ability to really find things that are unexpected. Now, just as a quick example of how this might work, as recently as 2005, some of us who've been doing modeling in this area were picking up a U.S. residential risk factor in international portfolios. And I wish I had recorded some of these meetings, but I had meetings with very senior financial institution executives saying, look, you have U.S. residential real estate exposure that you should be worried about. And they just dismissed it. They said, wow, first of all, real estate prices will never fall in the U.S., and secondly, we can't possibly have that kind of exposure. But the point here is if you don't have the model, if it's not truly multi-asset class, if it's not truly drilling down to the underlying systematic drivers, you're going to miss those clues. And actually, later on, I'm going to talk about, let's skip this. I'm going to talk about an emerging risk factor that we're starting to see in the data. Now, if we want to do factor modeling, what is it that we actually do in practice? Well, the first thing is we do have to have data, and the predominant data that we're using are market prices. So we will look at, just to give you an example, we process daily about 50,000 global equities, and then something like 20 to 30,000 bonds. That gets whittled down to a smaller subset based on some liquidity criteria. And from there, we estimate a factor structure. And this is called a latent factor structure. So if you're not familiar with this concept, this is something that comes out of statistics. It basically says, I'm going to start with some data set, and I'm going to try to understand a smaller set of systematic drivers that are responsible for the outcome. Now, this is being used in other places, like Google uses this in their influenza estimation algorithms. If they're trying to figure out where epidemics are developing for flu, they will do latent factor analysis. It's quite commonly used in medical research. But once we have that underlying factor structure, then I have to figure out how to relate those to conditional values. So that's an important step. That's where you have to have these conditional valuation functions that allows me to transform the factor draws into some conditional value. From there, I can then run a simulation, and I'll actually walk you through an example if I have time, and then test volatility, look at expected tail loss, and then match the output with particular parameterizations and the investment horizon that I'm analyzing. So once I have got this infrastructure in place, then putting a new asset class into the mix is just a matter of linking through a conditional value function those factors and the position value. Okay, so that's where the research challenge or the analytics challenge lies. And I can figure out a range of analysis that then can be used to help me look at allocation and do portfolio risk analysis. Now, latent risk factors, if you're not familiar with them, are quite powerful in that they give you a distilled view of the independent drivers. Now, one of the problems that you have with what are called fundamental factor models is that the drivers overlap. So let's say I think GDP growth and interest rates, or U.S. interest rates, are two risk factors that are driving value and thus my portfolio risk. The problem is they're not independent. So there's some correlation between those two variables. What I'm doing with my latent factor analysis is I'm distilling down to a set of independent risk drivers and trying to figure out how those change over time. This allows me to have a dynamic correlation structure. I can have a much more flexible characterization of emerging risks. Now, this comes at a cost. The cost is I don't have a straightforward way always of interpreting those factors. So I have to have another step later, which we call a mapping step, where I take my latent factors and map those back into fundamental factors because I need to have some way to understand what they are. And so that is one challenge that you have with latent factors. Now, it's not to say that you shouldn't use fundamental factor models. You should. As I mentioned before, we should be the fox, not the hedgehog. We should have multiple models. It's just that latent factor models, and this would be a much more technical discussion. I'm happy to discuss this with anybody at another time. They're just more risk performant. They do a better job of out-of-sample risk forecasting. That's one thing that's quite powerful for latent factor models. But I don't have the ability to identify them quite as easily. I have to rely on some kind of statistical analysis. Another problem is latent factors are not as stable as fundamental factors, although that's a bit of an artifact of the way that you do the modeling, because you're choosing a fundamental factor. And just for those of you not familiar with these concepts, it doesn't have to be just macroeconomic indicators. I mean, we often talk about the value factor, or we talk about growth. Sadly, the word factor is abused in many contexts, so people lose the meaning. But the point is that it's some kind of driver of risk. So fundamental factors by construction are more stable, although there are things that you can do in the latent factor modeling approach to make it more stable. But you get much more dynamic analysis with latent factors. And these are just some examples of the different kinds of factors. Now, I wanted to identify one emerging factor. So in 2005, there was this emerging U.S. residential real estate factor that actually some of us that had been looking at the data identified before it was all over the news. One new factor that we see in the data, just to give you an idea, is what I'll call a carbon factor. So if you happen to be a company that emits a lot of carbon in your business because of the changing regulatory environment and the potential for carbon taxes and things like that. So I have this picture of Antarctica shrinking, the ice shrinking. But this is an example. My guess is the fundamental factor models in a few years will have some kind of a carbon factor. But we're already seeing this in the latent context because it does appear to be emerging. Now, if I then shift into multi-asset class portfolio analysis and I want to run lots of simulations, really what I'm focused on is this part here to the left, the stress losses. So this is where I'm seeing all the losses that I'm concerned about, and I just need more simulations to do that analysis, as I mentioned. Now, the process for simulation, once I've identified the market securities and extracted the latent factors, I then have to go back to my individual positions and figure out how they relate back to those factors. Now, for unlisted assets, this again becomes data dependent. We have an advantage at State Street because we have access to databases that give us some of that data for some alternative assets, and there are some other data sources out there that you can look at. Otherwise, you're left with doing proxying to come up with the factor loadings, but that's still probably a good first step. Then I simulate the factors themselves, so that's just like running a whole bunch of scenarios. I apply my conditional value models. Now this, depending on the asset class, I can introduce quite a bit of nonlinearity into my portfolio risk model via this conditional value function. I use that to then just stack up a whole bunch of possible outcomes. So I've run 1 million simulations. I then have 1 million possible values for all my exposures or positions. Those then get stacked up, and I can then get the distribution that I showed you before. That becomes the output, and I can start drilling into the source of issues. Now, if you look at combining multiple asset classes, this figure just shows you this is the way or the degree of development we have in modeling. So there's like a big chunk or a big focus on equity. An interesting aside, equity accounts for something like a third of all the world's investable assets. But if you look at the finance and economic literature, or even the finance modeling, risk modeling, it usually consumes 80 to 90% of that time. That's a problem. So really, some of these other asset classes like corporate bonds or sovereign bonds, alternative asset-backed securities, et cetera, this picture should be inverted. We should be spending more time in our modeling, and I think this is happening now, than in equity. So that's an important part of building truly multi-asset class models. And this gives you an idea, this is really the order in which we're working on this modeling problem. We've already have some prototypes for private equity. We're starting to look at real estate and commercial, both commercial and residential. Liquidity becomes a big issue there. Infrastructure, we're having some difficulty mapping into factors, and then private loans I think are quite interesting because we have a whole body of structural models we can use, but then the ability to parameterize those are heavily data dependent. But all of these I think can be integrated into a multiple or multi-asset class portfolio where I've got equity and fixed income already modeled. Then the final step, as I mentioned, is I need to map my latent factors into some kind of interpretive factors. So that interpretive step is something that you can't avoid. Now, if I start with a fundamental factor model, I don't actually have to take this step, but I lose the dynamism. I'm not picking up emergent factors, and I may have some degradation on the risk performance. Now, one of the things that I kind of skipped over, but we've done some research, the fundamental factors and latent factor-based models generally perform about the same in normal market environments. Where you see differences is when you move into market breaks or some kind of big regime shift. That's really where the latent factor model gives you a lot more out-of-sample predictive power. Now, what are the enablers? Why is it that we can do all of this today? And this has really been in the last few years. Well, the hardware speed and cost has come down substantially. We now have something called massively parallel processing, often called MPP, and high-performance computing architectures that are now reasonable in terms of their cost. There's lots of data sets that are being developed. One interesting area of work, this is a small research project we're looking at, is that there are new data sets that have not typically been used in economic or financial modeling. So for example, looking at the degree of lumens from the satellites out of China to estimate GDP growth, as opposed to relying on Chinese statistics. Or tracking, you can now get data sets that track all the container traffic, so you can see where ships are actually going and what the trade flows are. There's this whole new movement called Internet of Things, where lots of products are now being embedded with GPS-enabled radio frequency IDs. That's all going to feed into data sets that will allow us to do a better job of figuring out the economic environment. And so that's a pretty interesting area of new research. Like, how do we take all that data and put it into one big picture to get a better estimate of the overall macroeconomic and portfolio risk? And then visualization has gotten a lot better. Ultimately, if you can't communicate the output, it's not going to work very well. Some of the new methodologies, the latent factor models, the regime conditioning, this is also quite important in enabling our ability to do this kind of analysis, which wasn't available before. So going forward, this is just giving you a sense of the research that we're working on, is extending the same factor models to not just assets, but also liabilities, so that you can actually get an integrated asset liability view to drive decision making. The ability to move from single horizon analysis to multi-step analysis. We think that'll be quite important for particularly certain types of unlisted assets where you have something called path dependence. Liquidity modeling is a big issue for us. Typically we model the liquidity first before we then put it into this larger picture of portfolio risk modeling. And then trying to come up with optimization algorithms that don't rely on volatility, but rely more on long horizon expected tail loss. So over longer time horizons, where are you going to get the big problems, and using that as a basis for optimization. These are all something that we think is quite important.